Let's get across the market open now. Jessica Amir joining us from Mumu. Jess, welcome back. Of course, heightened volatility. That's an understatement, isn't it, what we're seeing at the moment? How would you describe what we saw on Wall Street overnight?
Well, a couple of words. Investors are pretty dizzy, bruised, and Trump's tactics are causing more havoc. So expecting more pain ahead. 1 minute, actually, it was 7 minutes to be specific. In 7 minutes, we saw $2.5 trillion of a rally be completely unwound, and that was completely evaporated. So it shows you how flippant and wild Donald Trump's second term is. And then investors really don't know what way he's going to move. So stocks are pretty stuck in no man's land until his administration closes off those negotiations. And I guess Besant said that could be maybe June. So maybe we'll be stuck in the mud till then.
Yeah, in fact, just evidence there that the market is desperate for more clarity from the president, given there was news that perhaps he would pause those tariffs for 90 days, but then they dismissed that, and we saw those stocks move as a result.
Yeah, absolutely. I think it's a serious concern that we are seeing hedge funds now experience some of their highest amount of margin calls since COVID. We are seeing money continue to come out of equities for the most part. Sure, some investors overnight, Andrew, did buy the dip on the potential pause that was completely pulled like a rug out underneath markets. But sure, we do have a $7.4 trillion stockpile of cash. That's a record in money markets. So you would be expecting that to come back into equities only when certainty is. But the only certainty in town at the moment is that uncertainty will prevail. And that's why markets are probably going to be stuck in quicksand while negotiations are underway. And of course, the big, elephant in the room is that the tariffs on China could be increased by 50% if now Trump is asking Beijing to unwind their reciprocal tariffs on the US. So that could cause markets to materially move down lower if we don't see that negotiation successfully go ahead in the next 24 hours.
And Jess, of course, eyes also turning to central banks and how they're likely to respond, but of course, very difficult for them to move given that uncertainty.
Yeah, absolutely. It was interesting to see Jerome Powell was quite calm last week, but of course you'd expect Jerome Powell to be calm. But today, the RBNZ, I guess, will be the first central bank to really step up and speak. And I guess you might see mounting pressure on them to maybe cut more than the market is expecting. There's lots of talk about that. Whether they do that or not is another thing. But it'll be very telling if the RBNZ does cut far more than the cut expected today. And that would perhaps breathe a little bit of concern into markets, saying, hey, we've got a central bank here who's really worried about the state of flux, the destruction that these new tariffs are going to cause. So that'll be one thing to watch across the Asian Pacific session today.
All right, what are your observations of what we've seen on the local market then, given those falls? How are Australian investors responding?
So I think I was actually wrong. I came on the show a few months back and also was updating the thinking several weeks ago, saying that I believe the pullback for the Aussie share market would probably look exactly like the first Donald Trump-induced trade war of 2018, when we saw the market fall 15%. So I was wrong, but I actually said that we would fall 15%, and we've done that now. That's exactly happened. But why I'm saying I'm wrong is because I'm now a little bit more bearish than I was. So yes, markets have fallen exactly as they have in the first Trump trade war. The ASX XJO is down 15%, but you'd be expecting a lot more pain ahead because we're still going through this more rigmarole. We don't really know the certainty of tariffs. That certainty is not going to be known for some time. But that being said, Andrew, we are starting to see investors starting to nibble into this buy the dip mentality. We did see some pleasing results from Samsung, perhaps one of the first tech companies to report. They just reported after the US market close a far better than expected profit. So we are going to see dribs and drabs of good news, and investors might be leaning into this, but you'd be expecting more downside ahead, particularly because we're waiting to see what happens with China. If China and the US negotiations, they're sour, that means basically more downside for commodities, secondly, more downside for tech, and broadly the Aussie market. Of course, one of our biggest consumers is China, so it wouldn't be a very good day for the Aussie market tomorrow if those negotiations turn bad.
Yeah, any particular stocks or at least sectors you're watching at the moment? And you mentioned China, obviously those commodity-related stocks are under pressure.
So the heavyweights, BHP, Rio Tinto, even if you think about financials, like the magnitude of the sell-off that we've seen over the last couple of sessions is starting to really uncover some long-term buying opportunities. And we've got to remember that fortune favours the brave. Every time we have seen the stock market crash or the stock market go into a bear market, over the coming 12 months, the market has been higher. So BHPs, Rio Tintos, CBAs, those quality stocks with high repeatable cash flows, they're probably going to see some dip buying. More so, I'd be interested in looking at the financials. So the financials are likely to be hit the least by any tariffs, of course. So I'd potentially be looking to uncover some potential dip buying opportunities there and see how that fits into your portfolio. The other thing is that we are experiencing higher levels, and I guess in the insurance companies that are making money from bonds. Of course, bonds are higher, while their yields are a little bit lower. They are buffering up their profits. So it is good to see some insurers and those that do have large bond positions are faring better than most. So I think for some, you'll be looking at buying the dip into potentially the QBEs, Suncorps, etc.